Jitendra Shriram, Director and Head of Research with HSBC Securities. Jitendra, first, what do you make of yesterday's selling? It came more like a bolt out of the blue. Nobody was expecting a 100-point shave off on Nifty yesterday, and it came despite any institutional selling.
Yeah, good morning. I think it was a bit of a surprise, and I think a lot of it has got to do with the amount of arbitrage money sloshing around in the Indian system. I would reckon that anywhere the size is between $12 and $15 billion, and my sense is that you did see a lot of ARB unwinding happen yesterday. And, some of the counters, typically, when you have such a day of carnage like you had yesterday, typically the defensive names tend to do well. So you would logically expect names like, say, an ITC or a Bharti, for example, to actually probably not fall as much as the market. But yesterday was quite surprising in that, these are the names that led the fall. Obviously, there are certain reasons which can be ascribed that you had these stocks actually perform very well in the run-up to this entire fall, so maybe there was an element of profit booking, but overall I would think that ARB unwinding was probably the biggest reason that you saw this kind of fall. Obviously, some amount of data on the trade deficit side also did not help the or soothe investor nerves as such.
Are you a buyer of this market at the current juncture, or you are waiting for lower and better entry points?
Definitely waiting for lower and better entry points. I would definitely say that given the kind of run-up that our market has seen in the last 30-45 days, I would be quite cautious on this market at this stage. Second point also on this count is that, typically the better part of the results comes out in the early stages of the result season, and normally the second half you typically have some of the weaker numbers. So, you will probably see some toning down of the growth that you have been seeing in the fourth quarter as a lot of the industrial names, the metal names, probably the state-owned banks and all report. And I suspect that it will bring a kind of a sobering temperament on markets then.
What's the call in terms of sectors right now, or even stocks for that matter, on the index itself? Because we've seen large caps rally. However, traditionally in the past, like last year, there was a bigger performance coming in from the mid-cap universe. But it seems like this rally is more focused, polarized. It's focused on large caps, and then within large caps, it's more focused on the defensives.
I think it's a trend that you're seeing mirrored across even the larger markets. For example, even if you look at the US markets, I think consumer and areas like healthcare have been areas that have done well. I think India is no different. And when you speak about sectors, etc., we continue to be much more positive on the defensive side of the market. So we are positive on exporters. So we do like names in the healthcare IT segment. We do like names in private banks. But overall, given this kind of an environment where you have elections probably in the next 12 months, sometime by May next year, I would reckon that, no corporate is going to pull in the big investment decisions at this stage. So, hoping for a big turnaround in industrial recovery is probably too bullish. So to that extent, I would think a lot of people will just wait and watch and probably take the investment calls closer to next year when they have some kind of idea on what kind of political establishment is there, what is their kind of investment policies and so on.
Jitendra, how exactly are you you're approaching IT stocks? One side you got value, which is Infosys and Wipro. Other side you got growth, TCS and HCL Technology. So what is the best way to approach IT? Hunt for value or lean towards growth?
Well, our top pick in the IT space remains TCS. So we are pretty much on the, as you would classify it, I would say we are much more on the growth end of things. See, it's also a case of expectations and delivery. In a sense, in a lot of IT names, the issue has been a little bit of a patchy performance, 1 quarter of deliverance and 1 quarter of disappointment and so on. Whereas in names like TCS, what we have seen is that some kind of consistency is there at least over the last 8 or 10 quarters. And I think in this kind of an uncertain environment that we are in currently, markets willing to pay up a premium for some consistency in performance, and which is why I think TCS is something that scores within the IT pack.
Right. What about the rate sensitives? We just had a flash from S&P talking about how the asset quality stress is abating. Time to buy PSU banks?
Well, we are not very positive on the PSU bank space. Typically the asset quality trends will continue to grind a little bit lower even after the economy turns. So although we may be arguing for economic turn coming probably in the next 1 or 2 quarters, you may see some bottoming out effect. At least agri should recover this year on the premise of a normal monsoon. But the fact is asset quality trends will continue to grind southward before the turn comes up there. And given the kind of run-up that we have had in the last 30-45 days, I would be cautious on state-owned banks. So we stick to the private banks. So we like names like, HDFC Bank or IndusInd or ICICI there.
What is the case to buy ICICI Bank? Because ICICI Bank, at the end of the day, is still focused on corporates, unlike HDFC Bank, which is a retail-focused bank. If your view is that the private, investment cycle is unlikely to pick up, why would you like to buy ICICI Bank ahead of the curve?
Okay, I think there are, your point is absolutely valid. So I'm not saying that the retail end of the bank is not something where one should be. So HDFC Bank clearly scores there. But having said that, I would argue on 2 different counts. See, look at it from an ROE expansion perspective. ICICI in the last decade for, whether you penalize, whether you call it hyper aggressive growth or whether you call it, various other investments that they made, their need to access capital markets was far too profound, whether to fund insurance losses or whether to shore up the tier 1 to meet their growth ambitions. I think post 2008, 2009, what you have seen is a much more normalization of growth. And also parallelly what has happened is after the funding losses of the insurance business, that business has started breaking even now. So the propensity of these businesses, whether because of growth or whether because of insurance, to soak up tier 1 capital from the main bank will now be far fewer and at longer intervals of time. So the ROE cycles can actually expand for longer periods of time before they get dampened by capital raising. And to that extent, I think structurally this business is looking far more attractive in terms of a sustainable ROE going forward, and which is our base case on ICICI as such.
Give me a flavor of your current model portfolio. What are your top 3 recommendations? And from the mid-cap space, where are you advising your clients to allocate 5 to 7% of the existing portfolio?
Well, from an overall portfolio perspective, we clearly are positive on energy given the kind of reform noise that is there. Even recently, we had a diesel price hike. So we do like names like ONGC, Kane there. Also, when you look at some of the smaller names, we do like something like a Petronet LNG there. Secondly, on banks, we already spoken about the private sector being the main area. Other than that, for beta play, we do like some of the names like REC, PFC and IDFC there. We do think that, given this kind of easing which has happened on the monetary side, some kind of funding improvements could be seen in people who borrow in institutional markets. So IDFC, REC, PFC could be gainers there. Further, you also have the tailwind of some kind of SEB reforms kicking forth, which could actually be sentimentally positive for the power names, REC and PFC. Pharma, we clearly, Sun Pharma has clearly been our top pick in the sector. But other than that, on the smaller names also, we are quite excited about names like Ipca there. Other than that, metals, we have been fairly selective. The one name that does appeal to us at this point is Hindalco. IT, I spoke about TCS already. I would say the other area where we are positive about is the utility space. So Tata Power is something that appeals to us. NTPC is something that appeals to us. On a mid-cap side, one could look at names like JPVL there. Selectively on infra, I would say one could look at names like ILFS Transport, which is something which we like as such. And of course on telecoms, we do like Bharti.
So some stock-specific questions at you, because you mentioned some mid-cap, starting with Ipca. Why do you like Ipca? It's a low-margin business. They are in the business of simply giving drugs for, they're simply in the business of exporting drugs to Africa, which is a 17% return on equity business, much lower than Sun Pharma or Lupin.
Yeah, but look at the valuation differential also now. So clearly from a valuation perspective and the kind of growth that it is posting consistently, it is something that appeals to us. We think that the stock should be able to do somewhere between 20 to 25% CAGR in earnings over the next 3-year time frame. So that's one name that we clearly like.
All right, Jitendra, we leave it at that. Thanks very much for joining us with your views on the market. Appreciate it.